This is part 9 of our Chapter 3 video lecture series. There may be more videos, but there will be for just specific problems, probably at the end of Chapter 3. Let's review some of the topics we covered here in Chapter 3. The main goal is to learn the different types of income that can be reported on a tax return. So we've already covered things like wages or salaries that are first reported to the taxpayer on Forms W-2, and then interest income in line 2 probably reported to the taxpayer on Form 1099 INT. So if the total taxable amount is more than 1,500, you have to list them out on Schedule B. Also here in box 2A would be tax exempt interest, or sometimes we call that municipal bond interest that's tax free. Even though it's tax free, we still have to report it here in line 2A because it may affect the amount of Social Security benefits that are taxable in line 5A. Dividends are reported on line 3 on Form 1099 DIV to the taxpayer. And again, if the total is more than 1,500, we'll have to list them out on Schedule B and put those ordinary dividend totals here in line 3B. And included in the ordinary would be qualified dividend amounts listed here in 3A. Again, the amount here in 3A is already inside of that 3B, so don't double count the income. We've talked about taxing this qualified dividends at a lower rate using something called the Qualified Dividend and Capital Gain Worksheet that's linked inside of our Chapter Resources folder. IRAs and pensions in line 4 are reported to the taxpayer on Form 1099R, R for retirement. And the gross amount is here in box 4A or 4C, and then the taxable amount here in the right-hand columns. So we went through a couple different calculations or worksheets to determine if anything is going to be tax-free or here in the right-hand column, taxable. The amount of Social Security is reported to the taxpayer on Form 1099 SSA, or really SSA 1099. So again, the gross amount here in the left-hand column, and then the taxable amount, typically 50 or maybe up to 85% will go here in the taxable column on the right side of our 1040 form. Capital gains. We'll see this topic at the very end of our semester when we cover chapters 10 and maybe 11. So let's talk about other income that's reported on schedule number 1 and subtotaled and re-reported here in line 7A. So I think a couple items we've already covered, like alimony. Yeah, the rules for alimony. Business income, this is going to be the first chapter we start next semester in Accounting 137. I believe that's chapter number 7. Gains and losses we saw in the previous 1040 form, and we'll again cover that at the end of the semester. But something similar to that is if a business sells its assets like a delivery truck or an automobile or office building. That's reported on this form here that we'll learn next semester. Also next semester, if you're a landlord, here's rental operations. Or if you're a partner in a partnership or a shareholder in a type of corporation called S corporation, or a beneficiary of a trust or estate, maybe you got to report income from those entities and then fill it in on this Schedule E and then rewrite the total over here on this Schedule number 1. These are topics for next semester. Farm income is very similar to business income, except the accounting is slightly different. Let's talk about unemployment. A big topic now during this pandemic for COVID-19. A lot of people, especially here in Hawaii, are unemployed. So after the year's over, the government is going to send them this form, a 1099 G for government. And the dollar amount of the unemployment pay received during the year is going to be reported in box 1. The whole thing is taxable for both federal and state income taxes. So try to make sure the taxpayer has enough federal income taxes withheld during the year. Also state income taxes withheld since it's taxable here in Hawaii. Okay, so that unemployment amount will go here in line 7 of the Schedule 1. Another use of this schedule, of this 1099G, again, G for government, you'll probably receive another 1099G if you had received a state refund during the year. You won't get a 1099G for a federal refund because federal income tax refunds are never taxable. State income tax refunds generally, well, I shouldn't say generally, may or may not be taxable. It depends. So let's kind of figure out when it's taxable or non-taxable on this scratch paper. So let's go back a couple of years, so 2018, and let's do our simple tax formula. We have income and we're going to minus out our deductions. The deductions we learned so far was the standard deduction. But in chapters 5 or 6, we're going to see maybe we can deduct something, if larger, called itemized deductions to get to our taxable income that we look up on the tax table to get our total tax liability for the year. Now, in this itemized deductions are the state income taxes that were paid or withheld during the year. So if you make state income tax payments, pay real estate taxes, possibly even sales taxes, you can deduct it here as an itemized deduction. And again, you do this only if it's larger than the standard deduction. Now maybe you paid too much state income taxes during the year and you deducted the whole thing as an itemized deduction. If you pay too much state income taxes, here in the next year, let's call this 2019, in your various types of income, you're going to have to report that refund you collect from the previous year's overpayment, and it's going to be taxable. Again, because you deducted it here in the prior year, you got what we call a tax benefit of paying the state income taxes. Now, if you get it back, a refund, that refund amount now has to be reported as income. Now, there may be some exceptions to reduce the amount of taxable refund. So what you should be doing, if you did itemize in the previous year and got back a refund in the following year for state income taxes, is to fill out this worksheet here on page 83 of the 2019 1040 instructions. So you got to go through this to calculate out what's the taxable state income tax refund. Now keep in mind, most people don't claim itemized deductions. They claim the standard deduction. So if they have a state overpayment and got back that refund, the refund is not taxable because they did not deduct any state income taxes. They claim the larger standard deduction. Let's take a look at one more income item on schedule number 1. Again, taxable refund income is line 1 here, yeah, on schedule 1. So way down here, other income. It could be any kind of prizes you get, an award for doing a good deed, or a common one is gambling winnings. So you go to Vegas and you hit the jackpot and they give you a form, I believe it's a W2G, And the gross winnings you have for the whole year, you gotta report it here in line 8 of the Schedule 1. If you have lots of gambling losses during the year, you don't reduce the gambling winnings. The winnings all go here. Okay, winnings. The losses can be deducted, but not here offsetting the winnings. Again, to be able to deduct gambling losses, you have to claim itemized deductions. Again, that's a topic for chapter 506 later on. And if you claim the itemized deductions, that means you're not claiming the standard deduction that we're learning so far in the first few chapters of our semester. So again, common type of income way down here in line 1 would be gambling winnings, awards and prizes. Maybe jury duty pay is another common one. You add up all of this miscellaneous income and get a subtotal that goes back to the 1040 form here in line 7A that you total up here in line 7B. Okay, that's it for the regular lectures for chapter 3. Make sure you read the textbook and then work on the chapter 3 assignments.